You save $50 a month for 10 years. You follow the advice, just start somewhere. You're disciplined. You're consistent. You open your account after a decade and you've got enough for a used car. Not retirement, not financial freedom, a used Honda Civic. Let's talk about why just begin somewhere might be the most expensive advice you'll ever follow. Here's what they don't tell you. Starting somewhere isn't the same as starting smart. And the difference between those two things is the difference between retiring at 65 and working until you're 80, between financial security and financial stress, between building wealth and just staying busy. Picture this. Two people, both 25 years old, both decide to start investing. Person A puts $100 a month in a savings account because, hey, at least they're starting somewhere, right? Person B waits 2 years, learns about index funds, then invests $200 a month. Fast forward 40 years, person A has about $68,000, person B over $470,000. Same time frame. One person started somewhere, the other started smart. This is the anywhere but nowhere myth. The idea that any action is better than no action, that the act of beginning matters more than what you're beginning, that momentum beats strategy. And it sounds good. It feels good. It's terrible advice. Let me take you back to 2010, the rise of financial TikTok, Instagram, money gurus, YouTube channels screaming, just start investing. The message was everywhere. Don't overthink it. Don't wait. Don't learn. Just start somewhere. Anywhere. It doesn't matter where. Just begin. And people listened. They opened Robinhood accounts. They bought their first stock, whatever was trending that week. They put money into high-fee mutual funds because their bank recommended it. They invested in their cousin's guaranteed crypto opportunity. They started somewhere. And most of them, they lost money. But here's what made this advice so sticky. It's partially true. Not starting is a problem. Analysis paralysis is real. Waiting for the perfect moment means you'll wait forever. The best time to plant a tree was 20 years ago. The second best time is now. All of that, absolutely correct. The problem is what gets left out, because just start implies that where you start doesn't matter, that how you start is irrelevant, that a bad beginning is better than no beginning, and that's where people's financial lives go to die, in the gap between good intentions and terrible execution. Let me talk about what actually happens when you just start somewhere without strategy. You open a high-interest savings account. Sounds smart, right? You're saving. You're being responsible. You check the interest rate. It's 0.5% annual return. Inflation is running at 3%. You're not building wealth. You're losing purchasing power, slowly, quietly, consistently. Or you start investing in individual stocks because it feels active and exciting. You buy Tesla because everyone's talking about it. You buy GameStop because Reddit says so. You buy whatever your coworker mentioned at lunch. You're in the market. You started somewhere. You're also gambling, not investing. Here's the thing about starting in the wrong place. It costs you twice. First, there's the money you lose or the gains you miss. But second, and this is what nobody talks about, is the time. Time you can't get back. Time that could have been compounding. Time is the single most valuable asset in investing, and just start somewhere advice, waste it. Let me show you the math. If you invest $200 a month starting at age 25 and you get a 7% average annual return by age 65, you'll have about $525,000. Now imagine you just started somewhere, a savings account earning 1% for 5 years before switching to that same investment strategy. You'd end up with about $360,000. 5 years, $165,000 gone. But wait, there's more damage. Starting somewhere wrong doesn't just cost money, it costs confidence. You put $1,000 into a stock someone recommended. It drops 30%. You panic, sell, lose $300. Now you think investing is risky, scary, not for people like you. You pull back. You stop. You got started, and it destroyed your trust in the entire system. This is what I call the false start penalty. In track, if you jump the gun, you're disqualified. In investing, if you jump in without preparation, you don't get disqualified. You just lose. The race keeps going. You're just running it with a financial injury that never quite heals. So where does this advice come from? Why do people push just start somewhere so hard? Part of it is genuinely good-hearted. Financial advisors see too many people paralyzed by fear, never beginning, never building wealth. They overcorrect. They swing from be careful to just go because they're trying to break through the paralysis. But there's another reason, and it's less noble. The financial industry makes money when you do stuff. Trade stocks, they get fees. Open accounts, they get customers. Buy products, they get commissions. Just start somewhere is great for business. Whether it's great for you is a different question. And then there's social media. Hot takes get views. Spend 3 months researching index funds, tax-advantaged accounts, and asset allocation strategies doesn't fit in a 15-second video. Just start now does. The algorithm rewards simple. Simple isn't always right. Let's talk about what smart starting actually looks like. It's not sexy, it's not fast, it won't go viral, but it works. Step 1. Understand what you're trying to accomplish, not build wealth. That's too vague. Are you saving for retirement in 40 years? A house in 5 years? Your kid's college in 15 years? Different goals need different strategies. Step 2. Learn the basics. Not everything, not advanced options trading or cryptocurrency technical analysis. The basics. What's a stock? What's a bond? What's an index fund? How does compound interest work? How do taxes work on investments? This isn't years of study. It's maybe 20 hours of reading or watching quality educational content. 20 hours that could save you hundreds of thousands of dollars. Step 3. Understand fees. This is where most people who just start somewhere get destroyed. They don't realize their mutual fund is charging them 1.5% annually. Doesn't sound like much, right? Over 30 years, on a $100,000 investment, that 1.5% fee cost you about $60,000 compared to a 0.1% index fund. $60,000 because you didn't spend 2 hours understanding fees before you started. Step 4. Start with tax-advantaged accounts. If your employer offers a 401k match, that's literally free money. If you skip that to invest in a regular brokerage account because you started somewhere, you're leaving thousands of dollars on the table. A Roth IRA gives you tax-free growth. A traditional IRA gives you tax deductions now. These aren't complicated. They're just structured, and structure matters. Step 5. Default to simple. You don't need 47 different stocks. You don't need to pick the next Amazon. You need broad, diversified, low-cost index funds. Put money in consistently, let it grow. Boring? Absolutely. Effective? Devastatingly so. The data is overwhelming. Most people who try to beat the market by picking individual stocks underperform simple index funds. Now here's what's wild. Following these 5 steps might take you 3 weeks to a month before you actually invest your first dollar. And in that month, people following just start somewhere advice will look at you like you're overthinking it. They'll say you're paralyzed by analysis. They'll say you're missing out on gains. They're wrong. Because here's what happens over the next 30 years. They jump from strategy to strategy. They panic during downturns and sell low. They chase hot stocks and buy high. They pay fees they don't understand. They make emotional decisions based on market noise. And you set it and forget it. You contribute consistently. You ignore the chaos. You let compound interest do its magic. Let me tell you about Sarah, real person, fake name. Sarah started investing at 28 after her friend kept pushing the just start somewhere advice. She opened a Robinhood account, bought some stocks that were trending, felt good about taking action. 3 years later, she'd made some money, lost some money, mostly spun her wheels. Then she read one book about index investing, just one. She realized everything she'd been doing was backwards. She moved her money into low-cost index funds in a Roth IRA. She set up automatic monthly contributions. She stopped checking her balance every day. She checked in once a quarter. That's it. 1 week, 7 days. You now have a strategy that will outperform most professional investors over the long term. But here's what Sarah told me that stuck with me. I wish I'd lost money faster. Sounds crazy, right? But she meant it. She wished her bad strategy had failed spectacularly in year 1 instead of kinda sorta working for 3 years, because those 3 years gave her false confidence. They made her think she knew what she was doing. They delayed her actually learning. Slow failure is more expensive than fast failure. This is the hidden cost of just start somewhere. It's not that it always fails, it's that it sometimes succeeds just enough to keep you doing the wrong thing. You make 5% when you could have made 8%. You pay 1% in fees when you could have paid 0.1%. You take on risk you don't understand because, hey, it worked out last time, until it doesn't. Let's talk about the 2020 COVID market crash. Perfect case study. Markets dropped 30% in a month. People who had just started somewhere without understanding what they owned panicked. They sold everything. They locked in massive losses. Then they watched from the sidelines as the market recovered and hit new highs within a year. They missed the entire recovery because they never understood what they were doing in the first place. Meanwhile, people who had taken the time to build a real strategy, they knew this was normal market behavior. They knew their diversified portfolio would recover. Some of them even bought more at the bottom. Same event, completely different outcomes. The difference wasn't luck, it was preparation. Here's another pattern I see constantly. People just start with whatever's easiest and most accessible, their bank's savings account, their company's
Default 401k options, whichever app has the best commercials. And these options are designed to be easy, not optimal. The bank wants you to save with them. They're not optimizing for your returns. The 401k default is whatever fund company paid for the privilege, not necessarily the best choice. Think of it like this. If you were going to run a marathon, would you just start running with no training, no plan, no proper shoes? Technically, you'd be doing something. You'd be active. You'd be making progress. You'd also probably injure yourself, develop bad habits, and burn out before race day. Or you could spend a few weeks learning proper form, getting decent shoes, building a training plan. Same destination, drastically different journey. The anywhere but nowhere myth tells you the journey doesn't matter. Just move, just act. Direction is irrelevant as long as you're not standing still. But in finance, unlike in running, the wrong direction isn't just slower, it can be permanently destructive. You can't just run off a bad investment strategy. The losses are real, the time is gone. So what's the alternative? Smart starting, strategic starting. It's not perfect starting, perfect doesn't exist, but it's informed starting. It means asking 3 questions before you invest a single dollar. What am I trying to accomplish? What are the risks I'm taking? What are the costs I'm paying? Answer those 3 questions and you're ahead of 80% of people who just started somewhere. And here's the beautiful part. Smart starting doesn't mean slow starting. You can learn the basics in a weekend. You can open a Roth IRA in an afternoon. You can set up automatic contributions to a low-cost index fund in under an hour. The difference between somewhere and somewhere smart isn't time, it's intention. Let me give you the exact playbook for someone starting from zero. Day 1, read about the difference between stocks, bonds, and index funds. Watch a few videos, understand the concepts. Day 2, research tax-advantaged accounts, 401k, IRA, Roth IRA. Figure out which ones you qualify for. Day 3, compare low-cost brokers, Vanguard, Fidelity, Schwab. Pick one, not based on ads, based on fees and fund options. Day 4, open your account. Day 5, choose a target date retirement fund or a simple 3-fund portfolio. Don't overcomplicate it. Day 6, set up automatic monthly contributions. Day 7, stop looking at it every day. Check in once a quarter. That's it. 1 week, 7 days. You now have a strategy that will outperform most professional investors over the long term. Compare that to just start somewhere. Day 1, open whatever account has the best sign-up bonus. Day 2, buy whatever stock your cousin mentioned. Day 3 through day 365, check your balance obsessively, make emotional decisions, chase trends, pay unnecessary fees, and wonder why you're not building wealth like the people on Instagram claim to be. The math is brutal. A 25-year-old who spends 1 week setting up a smart strategy and invests $300 monthly will have about $750,000 by 65. A 25-year-old who just starts with a high-fee actively managed fund and invests the same $300 monthly might have $550,000. 1 week of preparation, $200,000. That's $28,571 per day of learning. Show me another investment with that return. But let's address the elephant in the room. What if you're paralyzed? What if you've been planning to start for years and you keep researching, keep learning, keep preparing, but never actually begin? That's a real problem too. Analysis paralysis is just as destructive as impulsive action. So here's the rule. Set a deadline. Give yourself 2 weeks to learn the basics. Then start. Not somewhere. Start smart. And if you're worried you don't know enough after 2 weeks, here's a secret. You'll never know enough. There will always be another article to read, another strategy to consider, another expert with a different opinion. At some point, you have to accept that good enough beats perfect. But good enough isn't the same as anywhere. Good enough means you understand what you're doing and why. Let's talk about the psychological trap of just start somewhere. It feels good. It feels proactive. You get to tell people you're investing. You get to check your portfolio. You get the emotional reward of taking action without the hard work of taking smart action. It's financial junk food. Tastes good going down, makes you sick long term. And the financial industry knows this. They know people crave simplicity. They know people want to feel like they're doing something. So they create products that are easy to start but expensive to maintain. High-fee mutual funds with no minimum investment. Trading apps that gamify investing. Robo-advisors that charge you for basic index fund allocation you could do yourself in 10 minutes. Now, I'm not saying all these products are scams. Some serve a purpose, but they profit from the just start somewhere mentality. They're counting on you not asking questions, not comparing fees, not understanding what you're buying. They want you to start somewhere, specifically with them, and never look closely enough to realize there are better options. Here's a real example. A robo-advisor charges 0.25% annually to build you a portfolio of index funds. Sounds reasonable, but you could build the exact same portfolio yourself with the exact same funds for free. Over 30 years on a $100,000 investment, that 0.25% cost you $23,000. $23,000 for a service you could replicate in an afternoon. But hey, at least you started somewhere, right? Now, I'm not saying you need to become a financial expert. You don't need to read academic papers on modern portfolio theory. You don't need to understand the Black-Scholes model. You need to understand about 6 concepts: compound interest, diversification, fees, taxes, risk tolerance, and time horizon. That's it. 6 things. Learn those and you're equipped to make smart decisions. But the just start somewhere advice skips all 6 of these. It says, don't worry about understanding, just act. Don't worry about fees, just invest. Don't worry about strategy, just begin. And maybe that works if you're incredibly lucky. But building wealth shouldn't require luck. It should require patience, consistency, and basic knowledge. Let's talk about what happens to people 10 years after they just started somewhere. Some got lucky. They started somewhere good by accident. Maybe their company's default 401k option happened to be a solid target date fund. Maybe their first random stock pick was Amazon. They're fine. They think the advice worked, but they're confusing outcome with process. But most people, though, they're disappointed. They invested consistently for a decade and their returns are mediocre. They paid fees they didn't notice. They panic sold during downturns. They chased trends and bought high. They started somewhere, but somewhere was the wrong direction. And now they're 10 years older with less wealth than they should have, and a nagging feeling that investing doesn't work for people like them. Here's the tragedy. It did work. They just didn't work it correctly. The system isn't broken. Their approach was. And because nobody told them to start smart instead of just start, they wasted a decade. You can't get that decade back. Those years of compound growth are gone forever. So let me ask you a question. If you were sick, really sick, would you just start taking medicine somewhere? Would you grab random pills off a pharmacy shelf because, hey, at least you're doing something? No, you'd see a doctor, get a diagnosis, understand the problem, choose the right treatment. Your health is too important to just start somewhere. Your financial health is the same. It determines when you can retire, whether you can send your kids to college, if you can handle an emergency, whether you'll be financially independent or financially stressed. This matters. This deserves more than just start somewhere. But here's what I want you to hear. I'm not telling you to wait. I'm not saying delay until you feel perfectly ready. I'm saying start smart, start informed, start with intention. The difference between those 3 approaches isn't time, it's effort. It's thinking before acting instead of acting before thinking. And if you've already started somewhere wrong, don't panic, don't feel shame, don't throw your hands up and quit. Course correct. That's the beauty of investing. It's never too late to shift to a better strategy.
pull your money out of high-fee funds, move it to low-cost index funds, stop trading individual stocks, set up automatic contributions, fix the foundation. Will you have lost some time? Yes. Will you have paid some unnecessary fees? Probably. But every day you spend in the wrong strategy is another day of lost opportunity. The best time to fix it was the day you started. The second best time is right now. So here's what actually matters. Starting somewhere smart beats starting nowhere. Starting nowhere beats starting somewhere destructive. The hierarchy isn't action versus inaction. It's smart action versus dumb action versus inaction. And dumb action, it's often worse than no action because it wastes your time, your money, and your confidence. Remember those two 25-year-olds from earlier? Person A who just started with a savings account and person B who waited 2 years to learn and then invested smartly. Here's what I didn't tell you. There's a person C. Person C spent 2 years planning to start but never actually did anything. Paralyzed by options, overwhelmed by information, afraid of making a mistake. At 65, person C has nothing. So the complete picture is this. Person C with nothing, person A with $68,000, person B with $470,000. Starting somewhere beats starting nowhere, but starting somewhere smart, that's how you actually build wealth. That's how you retire comfortably. That's how you create financial security. The anywhere but nowhere myth wants you to believe that person A and person B are basically the same. They both started, they both took action. The difference is just details. But $400,000 isn't details. That's the difference between retiring at 65 and working until 75. That's the difference between financial stress and financial peace. Details matter.
So, what should you do right now, today, if you haven't started investing? Step 1, don't just start somewhere. Step 2, block off this weekend. Step 3, learn the 6 concepts I mentioned: compound interest, diversification, fees, taxes, risk tolerance, and time horizon. Step 4, choose a tax-advantaged account. Step 5, pick a simple, low-cost index fund strategy. Step 6, set up automatic contributions. Step 7, stop obsessing and let it grow. And if you have friends or family telling you to just start somewhere, I want you to understand something. They mean well. They're trying to help. They know that not starting is dangerous, but good intentions don't make advice good. Thank them, then ignore them. Do the work to start smart. Because here's the final truth. Just start somewhere is advice for people who don't want to think. It's permission to be lazy. It's comfort for the impulsive. And it's expensive. Really, really expensive. The financial industry loves it because it makes them money. You should hate it because it costs you money. Somewhere isn't good enough. Somewhere isn't a strategy. Somewhere is just geography. You wouldn't tell someone lost in a forest to just walk somewhere. You'd tell them to figure out where they are, where they're trying to go, and choose a direction that gets them there. Finance is the same. So stop listening to people who tell you that any action beats no action. Start listening to people who tell you that smart action beats dumb action. Stop believing that momentum matters more than direction. Start believing that both matter, but direction matters more. The question isn't whether you should start. You absolutely should. The question is where and how, and the answer is somewhere smart, somewhere informed, somewhere strategic, somewhere that actually builds wealth instead of just making you feel productive. 10 years from now, you'll either wish you'd started today or you'll be grateful you did. But more importantly, you'll either wish you'd started smart or you'll be grateful you did. The difference between those two futures is what you decide right now, not whether to start, where. Don't just start somewhere, start smart. Your future self, the one who's financially secure, stress-free, and able to retire when they want, will thank you for taking the time to do it right. Because in finance, like in life, how you begin often determines how you end.